Welcome to the deep dive. Today we are tackling, well, a really big one. We've got this massive, complicated stack of sources, everything from government economic reports to the latest C-suite surveys.
And we're wading right into probably the most confusing, complex, and, let's be honest, high-stakes conversation in the modern economy.
Exactly. Artificial intelligence and the U.S. labor market.
It really is the ultimate economic puzzle right now, isn't it?
Mm.
Our mission today, it sounds simple, but it's absolutely crucial. We need to figure out why the data seems to be telling two completely different stories at the exact same time.
That's the core paradox, the thing we keep bumping up against.
Uh-huh.
On one side, you've got this pervasive, pretty unsettling business sentiment. These are the forward-looking surveys, the ones from mid-2025 we looked at, where business leaders are basically sounding the alarm, big disruption coming.
Indeed. And the figures, they suggest a planned restructuring is, well, it's already underway in their minds. We saw that nearly half of U.S. business leaders, 48% specifically, they're pointing fingers at high-salary, white-collar workers.
As layoff targets.
As the most likely targets for upcoming layoffs, yeah. And looking ahead, 58% think layoffs are likely in 2026. They're often explicitly linking these cuts to AI adoption, strategic shifts towards more automation.
So that paints a picture of, frankly, job cuts, hiring freezes, maybe massive white-collar automation. It sounds like a labor apocalypse is just around the corner.
That's the narrative. A powerful one. Impending widespread disruption.
But then you look at the other side, the government's economic reality, the sort of authoritative retrospective data, and it tells a radically different story.
It's the ultimate countersignal, isn't it? When you dig into that lagging data, like the Census Bureau's 2023 annual business survey, which gives you this incredibly wide, deep snapshot of the whole U.S. business landscape, though it's based on 2022.
Right, looking backwards.
Looking backwards. It suggests AI has had, well, a minimal net effect on the big picture, on aggregate employment numbers, at least so far. The vast majority of businesses that adopted AI back then reported that the number of workers did not change overall.
And skills.
The impact on the required skills of their existing workers also considered marginal, according to that 2022 data.
Okay, so we're left with this really confounding situation. Widespread fear, strategic planning for maybe mass disruption tomorrow, versus the official stats saying, hold on, not much has really changed in the aggregate yet.
Exactly.
So what we're trying to do today is reconcile those two signals for you, the listener. How do these fit together?
And the reconciliation, we think, is this. These signals aren't actually contradictory. They're just different facets, different views of a really profound and extremely rapid labor market restructuring that's happening right now. Our goal is to dive into what we're calling the underlying churn, that deep structural turmoil happening just beneath those calm-looking surface numbers. We'll be looking at the triple effect, how AI is simultaneously displacing some jobs, augmenting others, and even creating new ones.
Creating this massive disruption that the net aggregate data, well, it just can't capture it.
It smooths it all out.
Okay, let's unpack this. Let's start with section 1. Deconstructing the discrepancy itself. Why do the intentions, the fears of business leaders, those leading indicators, why do they seem so much more dramatic than the realized outcomes we see in the government stats, the lagging indicators?
Well, first, we just have to acknowledge the quantitative evidence that's fueling both sides, right?
Yeah.
On the disruption side, the intent looks aggressive.
Yeah.
Our sources show 28% of companies report they have already replaced jobs with AI in some way. And another 37% expect they'll have done so by the end of 2026.
So that's over half, potentially, by the end of 26.
Potentially, yeah. And this isn't just vague sentiment. This seems to be planned strategic intent.
Yeah.
It's getting built into corporate budgets, into restructuring plans.
But again, that official census data, the 2022 snapshot, said AI adoption had little impact on the number or skills of workers. How much of this difference is just timing? Is it just lag?
The timing is absolutely the crucial variable, and it kind of breaks down into two main factors, I think.
Okay.
The first is that temporal difference we mentioned, leading versus lagging indicators. Business surveys that capture intentions, expectations, they reflect the competitive landscape leaders think is coming.
What they're planning for.
What they're planning for. Economic data, like the Census ABS, captures realized outcomes, stuff that's already happened, already been executed. And there's often a significant lag maybe 18 to 26 months between a CEO deciding on a major pivot and that strategy actually playing out operationally, showing up in government payroll stats.
Right, it takes time to implement big changes.
Yeah.
But the second timing factor feels even more important here, the arrival of generative AI.
Precisely. That's the game changer. We have to remember that census data showing stability, it reflects 2022.
Pre-ChatGPT, mostly.
Largely pre-widespread corporate-level awareness and integration of these big foundation models. ChatGPT, the tech that really vividly showed everyone the potential for white-collar automation, it didn't really hit the mainstream consciousness, especially in boardrooms, until late 2022 and then all through 2023 and 2024.
So the anxiety, the planned layoffs we're hearing about in the 2025 surveys.
That's purely a reflection of the post-generative AI era. The rules for white-collar work, they fundamentally shifted, you could argue, in Q4 2022. And the official data? It's only now just starting to catch up to that new reality.
That technological inflection point feels massive. But there's another wrinkle, right? Even when companies start implementing AI, there's often this initial phase where productivity doesn't jump. It might even seem to drop.
Oh yes, the productivity J-curve.
Which might also explain why that early 2022 data looks so calm.
This is really critical context for you to understand. When any big general-purpose technology, think electricity, the internet, now AI gets introduced, the first phase, it requires huge investment.
And a lot of organizational learning.
It's not just plug and play.
Not at all. Companies have to invest in new infrastructure, retrain staff, troubleshoot all the unexpected errors, fundamentally redesign how work gets done. And this investment phase, it often creates a productivity dip. That's the bottom of the J-curve.
Okay.
And that dip can suppress immediate output gains and delay any big employment effects.
So early reports might show productivity is flat, or maybe even declining slightly, leading some skeptics to say, see, AI isn't really working.
Exactly. And the 2022 data, it probably captures a lot of that flat early investment phase. But business leaders today, in 2025, they're not looking at the initial dip anymore.
They're looking ahead.
They're forecasting based on their expectation of moving into the steep, upward sloping part of that J-curve, the part where they finally anticipate realizing massive efficiency gains and, well, the labor restructuring that comes with it. So they're planning the layoffs now in anticipation of that future efficiency boost.
That seems to be the logic, yes.
Which means the stability we might perceive in the aggregate numbers today, it could be highly deceptive, like a temporary calm before a pretty significant structural storm.
That's the perfect definition of the hidden churn. Macroeconomic stats, they only measure the net change. They lump everything together at the national level.
Let's walk through a quick hypothetical just to make that churn concrete.
Okay, good idea.
Right.
Imagine, say, a financial services firm. They decide to automate their routine credit risk assessment process. Pretty standard AI application now.
Right.
That automation allows them to lay off, let's say, 10 junior credit analysts. But to manage the new AI system, the data it uses, the outputs, they simultaneously hire maybe 7 data governance experts and 3 prompt engineers.
Okay, so 10 out, 10 in, net effect nationally, 0. The top line economy looks fine.
Exactly. But for the 20 people involved in that specific scenario, the disruption is seismic. 10 people just lost their career path.
Yeah.
10 others started completely new jobs that need vastly different skills. That is the churn happening beneath the surface.
And the sheer scale of this projected churn is what's driving the anxiety we see in those business surveys.
Absolutely. McKinsey projects the U.S. might need to navigate almost 12 million occupational transitions by 2030.
12 million.
12 million. And let's be clear, that's not a net job loss number. That's the staggering gross flow, the sheer volume of people moving from one type of job to a vastly different one. That's what workers are feeling, that uncertainty, and that's what's reflected in the business sentiment.
That 12 million figure is
it's
profound. We also need to pause here and acknowledge something important. AI isn't the only reason companies might be reducing headcount, right? There's a convergence of factors.
Absolutely critical point. The sources clearly show a confluence of motives. When business leaders talk about planned layoffs, they actually cite economic uncertainty and a desire for operational resilience as the primary driver. That was 55%.
Okay, so the economy first.
Economy first. AI adoption is a prominent secondary factor, cited by 35%. This is really important because it lets companies kind of merge 2 objectives.
How so?
Well, they can frame workforce reductions, which maybe they would have pursued anyway for short-term financial reasons, like cost-cutting, not just as a defensive move against a weak economy, but as a proactive strategic pivot. towards a leaner, more tech-ready future.
Ah, that's a powerful narrative tool. It lets them use the language of transformation, of innovation, when perhaps they're just reacting to economic headwinds or trying to boost quarterly earnings.
It absolutely shifts the conversation from potential financial distress to technological vision, which is, politically and strategically helpful for the firm. But it complicates the analysis for us trying to figure out exactly how much is AI versus other pressures.
Yeah. We have to separate the signal from the noise when we hear about layoffs.
Precisely.
Okay, so now that we've kind of established why the numbers might conflict, the timing, the generative AI shift, the J-curve, the hidden churn, let's dive into the mechanism of the change itself, this triple effect you mentioned.
Yes. It's so crucial we stop thinking about AI as just one single force, like a tidal wave washing jobs away. It's really three forces operating all at once:
Yeah.
displacement, augmentation, and creation.
And if you take away one key idea from this deep dive today.
This should probably be it. Understanding these three forces is the key to moving beyond that overly simplistic, frankly unhelpful binary of jobs lost or jobs gained. It's really about a fundamental restructuring of almost every work process in the economy.
Okay, let's start with force one, displacement. This is the automation front line. Historically, we mostly thought about routine manual tasks being automated first. But generative AI, well, it threw a curveball.
It really did. It proved that complex, non-routine cognitive work, the kind many of us thought was safe, the kind requiring analysis and judgment, is also incredibly vulnerable now.
So what kinds of roles are most at risk now?
We're seeing a complete revaluation of what counts as high-risk work. Roles that are centered on processing data, collecting information, making decisions based on established rules. These are now high-risk, almost regardless of the salary level.
And the official projections are starting to reflect this.
Yes, the Bureau of Labor Statistics projections through 2033 paint a stark picture. We're seeing projected employment declines for roles that traditionally required college degrees. Think credit analysts projected down 3.9%, claims adjusters down 4.4%, insurance appraisers down a hefty 9.2%.
Wow.
AI systems are increasingly taking over the core analytical and assessment tasks in those white-collar fields. They're handling the initial due diligence, the report drafting, the kind of stuff that used to be a human's full-time job.
And the sheer scale of the potential displacement, even if it's just displacing tasks within jobs, not necessarily the whole job, it's staggering.
It really demands our attention. Some economic modeling suggests that up to 30% of all the hours currently worked in the U.S. economy could be automated by 2030.
30% of work hours.
Could be automated. Now, again, like we stressed earlier, that's tasks, not necessarily entire jobs being eliminated wholesale. But think about what that means for the average professional. It means potentially almost one-third of your current workday might involve tasks eligible for automation within the next, 6 years?
That fundamentally transforms the job description, the day-to-day reality for nearly every worker.
It has to. And this task automation seems to be having a particularly immediate and frankly painful impact on the newest members of the workforce. This goes way beyond just general anxiety.
What did the research find there?
This is maybe one of the most alarming findings in the sources we reviewed, and it ties directly into something called the experience paradox. A Stanford University study found a staggering 13% relative decline in employment for early career workers, specifically those aged 22 to 25.
Right out of college, basically.
Right out of college in AI-exposed occupations. This trend started right after late 2022, coinciding with ChatGPT's rise.
13% relative decline for young professionals just starting out. Why them specifically? Why are they getting hit hardest first?
It seems to be because AI is particularly good at automating the entry-level tasks, the tasks that have historically served as that essential first rung on the career ladder.
Like what kind of tasks?
The basic coding assignments, summarizing research documents, writing routine legal briefs, doing initial data entry and analysis. Young professionals need those roles to acquire foundational skills, learn professional norms, gain that tacit knowledge you only get by doing.
And if the technology just automates those first steps?
It effectively severs, or at least severely damages, the critical pipeline for developing experienced talent down the line. It creates a potential structural deficit of experienced workers 5 or 10 years from now.
That feels like a societal risk, not just an economic problem for one age group. If you remove the stepping stones, you limit who can even access the top tiers of many professions.
Exactly. It makes that transition from education into the workforce potentially much steeper, much harder. You risk creating a bottleneck where Maybe only those who already have strong, non-routine skills can get their foot in the door.
Which is a huge challenge. But that challenge also leads us directly into force two, augmentation. Because for many high-skilled professionals, AI isn't the competitor. It's becoming the ultimate collaborator. It's redefining the human role.
This is the flip side of the coin.
So how do we distinguish between displacement and augmentation in practice? What does augmentation actually look like?
Augmentation is when AI takes over the mundane, the time-consuming subtasks within a complex job. It basically acts like a super efficient research assistant or a preliminary draft writer or a data cruncher.
Freeing up the human.
Exactly. Freeing up the professional to focus on the truly strategic parts, the creative thinking, the complex problem solving, the interpersonal engagement, the high-value activities that really require human judgment, empathy, dealing with ambiguity.
You mentioned some fascinating research about AI tools in call centers, this equalizer effect.
Yes, that was a great study. It showed that when AI tools were introduced to help call center workers, they disproportionately benefited the lower performing workers.
Really? How?
The AI helped them find information faster, suggested effective ways to structure their responses, essentially guided them through the process. And the result was it narrowed the productivity gap between the novices or lower performers and the established high performers.
So AI can actually democratize expertise in a way, level the playing field a bit.
It seems you can, yeah, level the baseline competence across the workforce, potentially.
And this is why we see some paradoxical growth projections, right? Occupations that seem highly exposed to AI are still projected to see really robust growth, sometimes even faster than average.
Absolutely. Consider software developers. Hugely impacted by AI coding assistants, yet projected to grow by nearly 18%, 17.9%, or personal financial advisors. AI can do basic market analysis, but the role is projected up 17.1% through 2033.
Why is that?
Because while AI handles the routine coding or the basic analysis, it simultaneously makes the human professional vastly more productive at their core job. And this increased productivity actually drives higher demand for the human strategic skills, designing complex software architecture, providing holistic, personalized financial strategy. Skills AI currently can't replicate.
So the impact really isn't predetermined by the tech itself. It comes down to the strategic choices companies make when they deploy AI.
That is such a vital insight from the research we looked at. That Stanford study, for instance, clearly distinguished between what they called automation-dominant usage.
Where you just replace a task chain.
Right. Delegate a whole task chain to AI. That was linked to employment decline. Versus augmentation-dominant usage, which involves more iterative human-AI collaboration back and forth. And that was linked to employment growth.
So companies are actively choosing their path. And that choice dictates whether their workforce is ultimately displaced or amplified?
It appears so. It's a strategic decision with massive consequences for their people.
And when companies do lean into augmentation, it seems like it naturally leads us to force three, creation. When you free up human brain power, people inevitably invent new things to do, new problems to solve.
And entirely new roles centered on the technology itself start to emerge.
What kind of new roles are we seeing?
Well, entirely new occupational categories. Things like AI oversight specialists, data ethicists, crucial roles, prompt engineers, of course, AI trainers, explainability experts, basically people focused on managing, training, auditing, and governing these increasingly complex and autonomous systems.
Jobs that literally didn't exist 5 years ago.
Didn't exist 5 years ago, and now they're often high-demand, high-skill roles.
But the creation isn't just about, prompt engineers in Silicon Valley, is it? It extends to other sectors, too, driven by the sheer infrastructure demands of AI.
Absolutely, and this connection often surprises people. Think about the massive energy requirements of AI data centers. That, combined with the broader global push towards renewable energy, is fueling immense job creation in related sectors. Some of the fastest growing jobs projected by the BLS are actually things like wind turbine technicians, projected up 44%, and solar photovoltaic installers up 22%.
Wow, huge growth.
Huge growth. And that's job creation happening maybe far away from the tech hubs, but driven indirectly by the foundational energy demands of the AI revolution.
Okay, let's quickly tie this back to the experience paradox we touched on earlier, because that feels like a crucial long-term risk hanging over all this. If AI displaces all those entry-level routine tasks, how do companies ensure they have the skilled, experienced talent they need in, say, 5 or 10 years?
It really does create a looming potential crisis. Companies today might be enjoying the short-term efficiency gains from automating those entry-level tasks, but they could be trading that immediate efficiency for long-term talent vulnerability.
How so?
They might struggle dramatically down the line to fill mid-career roles, the managerial roles, the complex strategist roles, because the younger generation of workers couldn't get that initial foundational experience they needed on those automated tasks.
It forces a rethink of how we develop professional knowledge.
It really does. We might need to pivot back towards more structured apprenticeships, maybe rotational programs, things that explicitly build those skill ladders that AI is currently, perhaps inadvertently, dismantling.
That's a fascinating structural challenge. You're potentially trading immediate financial optimization for future leadership sustainability.
It's a trade-off, and it's one that, frankly, doesn't seem to be actively solved by most corporations right now in their rush for immediate cost savings.
Okay, so given this complexity, displacement, augmentation, creation all happening at once, plus this experience paradox, we clearly can't talk about the U.S. labor market as just one single thing anymore.
No, definitely not.
We're seeing what you called sectoral decoupling. Different industries are moving on wildly different trajectories, right? Depending on their core challenges and how they're choosing to use AI.
Exactly. The national average unemployment rate, it's becoming a highly misleading statistic in this environment.
Yeah.
You absolutely have to look at the granular transformations happening industry by industry.
Okay, let's do that. Let's start with case study A, the technology sector. This feels like the obvious canary in the coal mine. It was the first place we really saw significant contraction.
The timeline is key here. The contraction in hiring, the waves of layoffs, they really started picking up steam in late 2022, right around the time generative AI burst onto the public scene.
And major tech firms have been pretty open about this, haven't they?
Yes. Companies like Microsoft, Intel, Salesforce, they've explicitly cited AI-driven efficiency gains as at least part of the justification for job cuts they've made in 2024 and 2025.
Can you give us a concrete example of that efficiency gain in action?
Salesforce is a really good case study here. They reported being able to significantly reduce their customer support headcount because AI agents started handling a truly staggering number of routine customer conversations, millions of interactions per month.
Wow.
So that reduction in human headcount, directly enabled by AI handling the first-tier support, translates into massive cost savings for them, arguably without compromising the immediate quality of basic service for many common issues.
That's a definitive example of AI allowing a company to achieve substantial efficiency gains, likely leading to slower headcount growth, even if not mass layoffs across the board.
It is. And this experience in tech, it probably serves as a pretty clear leading indicator for other knowledge-based industries. It signals that even if AI doesn't cause immediate mass unemployment everywhere, it's likely to severely constrain future employment growth, especially for those entry-level roles.
And we're seeing the impact on young workers there.
Yes, we have seen unemployment rise significantly among the 20 to 30-year-olds in those tech-exposed occupations. It suggests generative AI is creating some pretty strong hiring headwinds for recent college graduates trying to break into that field.
Oh, now let's immediately contrast that with case study B, healthcare. This sector seems to be using AI for a completely different strategic purpose.
Healthcare is really the premier case for augmentation right now, and it's driven by a profound need, not just a desire for efficiency savings. The industry is facing a projected global shortage of something like 11 million health workers by 2030.
11 million worker shortage.
Massive shortage. So AI is being deployed primarily to address a deficit of human capital, not to try and create a surplus by cutting jobs.
So in healthcare, AI doesn't replace the doctor or the nurse. It supports them, helps them cope with this huge labor shortage.
Precisely. Think about how it's used. AI helps radiologists spot subtle bone fractures on X-rays that the human eye might miss. It can help detect early signs of over 1,000 different diseases from medical scans. It can help triage patients more efficiently in busy emergency rooms, making sure the most critical cases get seen first.
The goal is effectiveness and maximizing the human's limited time.
Yes, and crucially, think about the administrative burden on clinicians. That's a huge source of burnout. There are tools now that can automatically generate detailed clinical notes and summaries just by listening to a patient consultation.
That's huge.
It's potentially huge for alleviating the crushing paperwork load, freeing up clinicians to spend more time on actual patient interaction, critical thinking, empathy, the human parts of medicine.
And this augmentation strategy, focusing on support rather than replacement, it's actually leading to job creation in healthcare, right? Especially for roles that leverage this tech.
Absolutely. We're seeing new specialized roles emerging, like AI diagnostic specialists. And perhaps most impressively, look at nurse practitioners. These are roles that heavily rely on advanced diagnostic technology and patient management systems. The BLS project's nurse practitioner jobs will grow by an explosive 52% through 2033.
52%, that's just incredible growth.
It's a fundamentally different growth story compared to the cautionary tale we're seeing in parts of the tech sector. It really highlights how industry context and strategic goals shape AI's impact.
Okay, let's shift gears to case study C manufacturing. They've been dealing with automation for decades, since the first industrial robots in the 70s. How is the current AI wave different from that earlier wave of robotics, the one that did displace around 1.7 million production jobs since 2000?
The shift seems to be entirely from simple task replacement to more complex human-robot collaboration. That initial wave of robotics, it was mostly about taking over routine, repetitive physical motions on the assembly line.
Stuff humans maybe didn't want to do anyway.
Often dangerous or tedious work, yes. The current shift, though, is focused more on cobots, collaborative robots. These are designed to work safely and dynamically alongside human employees,
Doing what?
helping with complex assembly tasks, intricate quality control checks, tasks that still require constant human judgment, dexterity, or sensory input, but where the robot can provide strength, precision, or tireless consistency.
So the goal has really changed. It's not just pure replacement anymore. It's about augmenting the human worker's capabilities on the factory floor.
Yes, exactly. One source quoted a manufacturing leader saying the goal is to augment the capability of those talented human beings. But this means the skills demanded on the factory floor have also completely changed.
Awesome.
The modern, high-tech factory floor. It requires workers to have proficiencies in data analytics, understanding the data coming off the machines. They might need to use augmented reality or virtual reality tools for complex maintenance procedures or training. And cybersecurity skills are becoming critical to protect these highly connected industrial systems.
So the jobs aren't necessarily gone, but the skill requirements have definitely elevated. Dramatically.
Dramatically. It's a transformation, not just an elimination.
Okay, finally, let's look at case study D finance and professional services. Banking, insurance, law, accounting. This feels like the epicenter of potential white-collar disruption, doesn't it? These sectors seem highly exposed to generative AI's ability to analyze documents, draft reports, process information quickly.
They absolutely are. These roles, think accountants, financial analysts, paralegals, insurance underwriters, they won't disappear entirely, not overnight anyway, but their day-to-day focus is shifting dramatically, often upwards towards more complex tasks.
How is AI changing those roles?
AI is increasingly handling the foundational, high-volume, often tedious tasks, things like collecting and reconciling financial data, ensuring regulatory compliance, drafting initial versions of client reports or contracts, synthesizing vast amounts of regulatory changes quickly.
So what's left for the human professional?
This forces the human to focus almost entirely on the higher value activities, building client relationships, exercising complex ethical judgment, managing sophisticated risks, developing creative strategies, all the things that require deep human nuance, context, and interpersonal skills.
And this shift towards higher value work perhaps explains why the BLS projects a decline for certain specific roles, like credit analysts.
Exactly. They're projected down 3.9%.
Yeah.
Because algorithmic models are getting really good at taking over much of the routine risk assessment, the initial due diligence based on quantifiable data. The human analyst is then needed for the more complex, borderline cases or for structuring unique deals.
Okay, so the big takeaway from this sectoral view is definitely the clear decoupling. A tech worker might face headwinds because of efficiency gains, while a nurse practitioner sees huge tailwinds because of labor deficits and augmentation.
Absolutely. The national average unemployment number. It's truly becoming a misleading fiction in this dynamic environment. You have to look deeper.
And all this complexity, this churn, it means that the process of finding and securing a job is also fundamentally changing. AI isn't just changing the jobs themselves, it's rewiring the new hiring paradigm. The very first hurdle in your job hunt is now often an algorithmic recruiter.
It's becoming incredibly common. 6 out of 10 U.S. companies already use AI in some part of their hiring process, and 74%, nearly 3/4, plan to increase their use of AI in hiring over the next 12 months.
What's driving that rapid adoption?
It seems to be driven by two powerful promises, mainly.
What?
Efficiency, just dealing with the sheer volume of applications many companies receive, and the hope for improved quality of hire.
Where is it used most?
Primarily for those high-volume initial screening tasks. Resume reviews, up to 79% of companies using AI report using it for that. And initial candidate skills assessments, about 66%.
And are companies actually seeing benefits? Do the sources suggest it's working for the employers?
The reported benefits are pretty substantial, yes. A significant majority, 74% of companies, report that AI has actually improved the quality of their hires.
That's a big number.
Yes. And the efficiency gains look remarkable, too. Some trial data we saw showed that using AI-assisted pipelines made qualified candidates 20 percentage points more likely to succeed in a subsequent blind human interview.
Interesting. Why would that be?
Potentially because the AI is consistently applying criteria and might surface strong candidates that a human screener, who might be biased, tired, or just scanning quickly, could overlook. Plus, it seems to cut the recruiter workload significantly. One study found it required 44% fewer interviews to make a successful hire.
Okay, so when governed well, AI in hiring can potentially surface quality talent more efficiently. But this process also introduces the really concerning perils of the black box. The very tool designed to maybe eliminate human bias could inadvertently amplify systemic bias hidden in historical data.
This is a massive area of risk, and importantly, companies seem to be aware of it, at least intellectually. A majority of companies using these tools acknowledge that their systems sometimes produce biased recommendations.
What kinds of biases are they seeing?
The biases most commonly cited by the companies themselves include bias based on a candidate's educational institution, 63%, their age, 44%, perceived socioeconomic status, 36%, gender, 29%, and race or ethnicity, 28%.
So if the past hiring data used to train the algorithm reflects historical inequalities,
The algorithm simply learns, systematizes, and scales that discrimination, often in ways that are much harder to detect or challenge than human bias. It bakes the bias into the code.
and the whole process can feel deeply dehumanizing for the applicant, can't it? Especially when you suspect you've been rejected by a machine without a human ever even seeing your application.
This was perhaps one of the most jarring findings. An alarming 3 out of 4 companies admit they allow their AI systems to reject candidates without any human oversight or review.
3 out of 4, just automatically screened out.
Automatically screened out. This creates complete opacity. A qualified candidate could be filtered out by an algorithm for reasons the company itself might not fully understand. There's often no recourse, no explanation provided, and really no way for the applicant to learn how they might improve or if the rejection was even fair. It erodes trust significantly.
And this opacity, this feeling of battling an invisible system, is what fuels the arms race we seem to be witnessing now. Employers use sophisticated AI to screen candidates.
And job seekers respond by using generative AI to mass-produce resumes and cover letters that are stuffed with keywords they think the algorithm is looking for.
It becomes a game of digital cat and mouse.
It really does. A chaotic, escalating cycle that probably benefits no one in the long run. Job seekers feel forced to shift their strategy away from genuinely showcasing their qualifications towards, essentially, digital subterfuge trying to trick the algorithm.
While employers deploy more sophisticated AI to try and detect AI-generated content or fake signals.
Exactly. Success starts depending less on your actual skills and experience and more on your ability to successfully reverse engineer the digital gatekeeper. It's a trend that really threatens to diminish the genuine assessment of human skills and potential in the hiring process.
Okay, so given all this churn, this restructuring, this changing hiring landscape, let's pivot to the crucial discussion, the human response. How do you navigate this constantly shifting landscape? We need to look at the great skills reset.
This reset is really the bedrock of future career success, I think. The data suggests that the tasks easiest for AI to automate, those requiring more basic cognitive skills like literacy, numeracy, simple data input, those are projected to decline significantly, maybe by 14% of total work hours by 2030.
So the value of that kind of basic routine cognitive work is shrinking fast.
It seems to be. Which means our human capital, the skills we invest in, needs to shift fundamentally towards things AI can't do well.
So if those basic cognitive skills are declining in value, what's surging? What are the complementary skills we should all be focusing on developing?
The skills that complement AI, the ones that allow humans to work with the technology effectively, those are surging in value. They tend to be durable, transferable skills. We're seeing 2 broad categories really explode.
Okay, what's the first?
First, technological skills themselves. Things like advanced IT proficiency, data analysis, AI, and machine learning development and management. These are projected to increase their share of work hours by over 25%. You obviously need people who can build, manage, and refine these complex systems.
Makes sense. And the second category, it sounds like it speaks more to the core of human interaction.
Absolutely. This is critical. Social and emotional skills, things like leadership, empathy, nuanced communication, collaboration, negotiation, cultural intelligence. These are projected to rise by over 10% in terms of work hours.
Why are those becoming more valuable because of AI?
Well, think about it. As AI handles more of the routine analytical or information processing tasks, the human professional is increasingly pushed up the value chain into roles and situations that demand complex judgment, ethical deliberation, creativity, and high-touch interpersonal engagement. The premium shifts strongly to those durable human skills that machines currently, and perhaps fundamentally, cannot replicate.
Complex problem solving, critical thinking, creativity, collaboration.
Those become the core differentiators.
But this intense period of change, the uncertainty, the need to constantly reskill, it's also clearly exacting a serious psychological toll on the workforce. Companies need to pay attention to this, right? We see pervasive AI anxiety. That stat, 64% of U.S. adults believing AI will lead to fewer jobs long term.
That anxiety is very real, and it has consequences. When you couple that fear with a potentially softening labor market in some sectors where hiring is constrained by those AI-driven efficiency gains, it can lead to a phenomenon some are calling job hugging.
Job hugging.
Yeah, it's where employees who might be demoralized, maybe burned out, or just generally dissatisfied, they end up clinging to their current roles anyway, even if they're unhappy, because the uncertainty of navigating that AI-filtered job market, black box fear we just discussed, feels too daunting, too risky.
So they stay put, even if it's not ideal.
They stay put. And this reluctance to change roles can feed into an overall decline in employee engagement, dynamism, and labor mobility, which isn't healthy for the economy long term.
And ironically, the implementation of AI itself seems to be causing burnout in many cases. This leads to a kind of productivity paradox. Executives see AI as this magic bullet for efficiency.
But it's often not working out that way on the ground, at least not yet.
Why not?
There seems to be a massive operational disconnect in many organizations. Executives assume AI is just plug-play, that it leads to immediate efficiency gains. However, our sources showed that a staggering 77% of salaried employees report that the AI tools they've been given have actually added to their workload, not reduced it.
Added.
They're often expected to integrate complex new tools into their existing workflows, sometimes with reduced staffing levels or increased performance targets, and frequently without adequate training or a fundamental redesign of the process itself.
So the company invests heavily in the technology.
But fails to invest sufficiently in the human training, the process redesign, the change management required to actually realize the technology's potential. And that leads directly to employee stress, frustration, burnout, and a failure to move up that productivity J-curve efficiently.
Okay, so if implementation is often falling short because we're not preparing the human side properly, what's the strategic imperative here? What are the clear action items for the key stakeholders, businesses, policymakers, individuals to try and future-proof the workforce and the economy?
Great question. Let's break it down. For business leaders, the absolute imperative is a mindset shift. They must move beyond just plugging in tools hoping for quick cost savings.
What should they do instead?
They need to seriously adopt strategic workforce planning, or SWP. This isn't just headcount planning for the next quarter. It means using data to proactively forecast the skill gaps they'll likely face not in 6 months, but in 3, 5, even 7 years out.
And then
Proactively planning and funding the upskilling and reskilling of their existing workforce to meet those future needs. This might mean reallocating budget away from constant external hiring toward building robust internal training programs, creating partnerships with educational institutions, really investing in their people's adaptability.
and redesigning work itself.
Critically, they have to fundamentally redesign end-to-end workflows to leverage AI for augmentation, not just blindly automate isolated tasks. It's about maximizing the combined value of humans and AI working together.
Okay, that's for business leaders. What about for policymakers? Their focus has to be on the worker caught in that churn, right? The person constantly needing to transition.
Yes, absolutely. The safety net needs modernization. The accelerating pace of occupational churn means we need systems that support workers through frequent transitions. This could involve seriously exploring things like portable benefits, healthcare, retirement savings, maybe even training funds that aren't tied to a single employer but move with the workers. They navigate different jobs, contract work, or the gig economy.
And lifelong learning.
That has to become a national priority. Policymakers need to catalyze a robust national ecosystem for lifelong learning. This could mean increased funding for public-private partnerships between industry and education providers, exploring models like individual learning accounts or ILAs that empower workers to take ownership of their continuous skills development throughout their entire career. The old model of front-loading education in your early 20s just doesn't work anymore.
And finally, perhaps most importantly for our listeners, what about the individual professional? What are the actionable takeaways for navigating this era of uncertainty?
For the individual, I think the path has maybe three core parts. First, you absolutely have to cultivate AI fluency.
What does that mean exactly?
It means going beyond just knowing AI exists. It means understanding its capabilities, yes, but also its very real limitations, its biases, where it excels and where it fails. It means learning how to use AI effectively as a powerful collaborator, a tool to enhance your own work, not just something that generates mediocre first drafts.
Okay, AI fluency first. What's second?
Second, double down on those uniquely durable human skills we talked about. Creativity, complex critical thinking, emotional intelligence, communication, collaboration, ethical reasoning. These are your true long-term assets, the skills that will remain valuable even as specific technical skills become obsolete more quickly.
Makes sense. And the third part, it feels like it has to be about mindset, not just acquiring specific skills.
Absolutely. The third part is embracing a mindset of continuous learning and adaptation. Adaptability is arguably the single most important attribute for career longevity now. The specific skills required for almost any job are going to be in a constant state of flux. The responsibility for staying relevant, for learning new things, for pivoting. It rests increasingly on the individual's commitment to ongoing education, experimentation, and retraining throughout their entire working life.
This has been a really profound deep dive. If we try to synthesize our findings, the big takeaway seems clear. This AI transformation isn't really about net job destruction, is it? Those aggregate numbers, they're kind of a red herring.
Exactly. It's fundamentally a story of rapid, deep structural restructuring of the entire labor market. And those 12 million projected occupational transitions we mentioned, that's the true story unfolding beneath the relatively calm surface numbers. That's the churn.
And crucially, that story, the outcome, it's not predetermined by the technology itself.
No, not at all. The extent to which the future of work is equitable, productive, and fulfilling is a direct result of the strategic choices that leaders in business, in government, in education make today. Choices about whether to prioritize augmentation over pure automation, whether to invest in long-term human capital development over short-term financial gains.
So perhaps the most valuable investment today isn't just in the algorithm itself, but in our human capacity to adapt, to govern these powerful tools wisely, and to strategically deploy them in ways that enhance human potential.
Well said.
So we want to leave you, our listener, with this provocative thought to mull over. If the ultimate impact of AI on your career, on your industry, on the whole economy is really contingent on corporate strategy, that choice between being automation dominant versus augmentation dominant, then what criteria should you use? As a job seeker, as a consumer, maybe even as an investor, how can you identify and prioritize companies that seem genuinely committed to investing in long-term human capital development, in building an augmented future, rather than just using AI for short-term cost-cutting and headcount reduction? How can you spot the leaders who are trying to build a future where humans and AI thrive together?
That's the critical question to ask.
Think about that choice. We'll see you next time on The Deep Dive.